All right, let's jump right in. We're going to tackle a huge problem that every single investor runs into. You're just drowning in financial data. So how do you find a really great company if you don't have a finance degree? Well, we're going to use a simple checklist, inspired by one of the best investors ever, Warren Buffett. Let's see how it works.
You've been there, right? You find a company that seems interesting, you pull up its financials, and boom, it's just this overwhelming wall of numbers. PE ratios, debt, growth rates. It feels like you need to be a Wall Street analyst to make any sense of it. So how do we cut through all that noise and get to a clear decision?
The secret? It's all about simplifying. Warren Buffett's whole philosophy boils down to a really simple idea. Buy wonderful companies, but do it at a fair price. It's not about some complex algorithm. It's just about understanding the business. Today, we're going to apply a simplified version of that exact thinking to a real company.
So here's our game plan. We're going to take a look at the utility company Xcel Energy, that's ticker XEL, and run it through a three-step test. First, we're going to check its financial foundation. Is it solid? Second, we'll look at its history, its track record. And third, maybe the most important step of all, we're going to see if the price tag makes sense. Let's get to it.
Okay, first things first. Is this business built on solid rock, or is it more like shifting sand? See, a truly wonderful company has to have a strong financial base. For a conservative investor, that means we need to look really closely at two things. How much debt is it carrying, and how good is it at actually making a profit?
Our first number is the debt-to-equity ratio, and it's coming in at 1.49. So what does that mean? Well, it means the company has almost 50% more debt than its own equity. Now look, for a utility company that has to build giant power plants, some debt is totally normal. But for someone thinking like Buffett, this is kind of like a yellow flag. Too much debt can create risk, and it eats into profits.
Next up, return on equity, or ROE. You can think of this like a report card for the company's management. For every single dollar that shareholders have put into the business, Xcel is generating about 8.5 cents in profit. Now, that's okay, but the truly amazing companies that Buffett loves often have an ROE that's consistently over 15%. So this one's not a failure, but it's not exactly a shining star either.
But here's where the story starts to get a little more interesting. The company has grown its earnings per share by almost 12% a year, on average, for the last 5 years. Now that is a real strength. It shows us that management knows how to consistently grow the bottom line profit for the people who own the company, the shareholders. That's a huge check in the pro column for sure.
So the company's financial health is a bit of a mixed bag, right? Let's move on to our second big test, its performance history. See, Buffett loves businesses that are predictable. He wants a long, clear track record of rewarding the people who own the stock. For him, consistency is absolutely king. Buffett loves companies with something he calls pricing power. That's the ability to raise prices over time without losing all your customers. It's what creates those steady, predictable profits he's always looking for. And one of the best ways a company can show it has that kind of confidence? By consistently paying, and even better, increasing its dividends to its shareholders. And on that point, Xcel Energy absolutely shines. 22 straight years of giving its shareholders a raise. Think about that. That is a really powerful signal. It tells you this is a stable, mature business that cares about returning cash to its owners. This isn't just some number. It's proof of long-term stability.
Now, when we look at the total return for investors, we see a pretty similar story of long-term consistency. Yeah, the last 5 years have been a little slower, but if you zoom out to the 10 and 15-year view, you're seeing really solid returns, right around 10 to 12% a year. This just reinforces that idea of a predictable, long-haul kind of business. So far, so good. Okay, so we've established that this is a solid, shareholder-friendly company, even with a few financial question marks. But now we get to the final and honestly the most important question. It doesn't matter how wonderful a company is if you pay too much for it. So what's the price tag? On one side of the scale, we have what you pay. The market's asking price is about $79 a share. But on the other side is what you actually get. Our calculation of its fair value, based on its profits, is only around $56. Whoa, that is a big gap. And for a value investor, it's pointing in the wrong direction.
This gap has a name, and it's maybe the most important concept in value investing. It's called the margin of safety. Just think of it like an insurance policy. You want to buy a business for way less than you think it's actually worth. That discount, that positive margin of safety, is your buffer. It's your protection in case you're wrong about something. And here it is, our final and pretty dramatic
number. The margin of safety for Xcel Energy is negative 40%. Let me say that again, negative 40%. This means, based on our calculation, the stock isn't trading at a discount, it's trading at a 40% premium. For a value investor, that's a total deal breaker. You're not getting a cushion. You're paying way more than its calculated value.
So, where does all this leave us? The company passed some of our tests with flying colors, but then it failed that last one, and failed it spectacularly. Let's put all the pieces together on a final scorecard and see the whole picture.
Here it is, all laid out, side by side. In the pros column, you've got that fantastic history of dividend growth, really strong earnings growth, and those consistent long-term returns. These are the signs of a wonderful business. But in the cons column, we've got that high debt load, that so-so profitability, and that huge glaring negative margin of safety. This tells us that while it might be a wonderful business, it just doesn't seem to be trading at a fair price right now.
So what's the big takeaway from all this? Well, a simple checklist like this is an incredibly powerful tool. It cuts through the noise and it forces you to focus on what really matters, the quality of the business and the price you pay for it. But it's not a magic formula that just spits out an answer. No, instead, what it does is give you a rational framework to make your own decisions. And learning how to think, not just what to think, well, that's the real secret to all of this. Thanks for tuning in.